Hi viewers, welcome back to Web Educate. In today's video, we are going to explore the consolidated statement of financial position when acquisition takes place, that parent company acquire 100% of the ordinary shares of the subsidiary, and also where a consolidation takes place on the date of incorporation, and also where the goodwill is a negative goodwill. What is consolidation in group account? Consolidation in group account is when a parent company acquire the net asset of the subsidiary, and two of them now combine together and become a single entity. Like I said in the previous video, before the acquisition of the ordinary shares of the subsidiary, two of them were operating at different levels. Parent company operating at its own levels, subsidiary company at its own level separately, and they prepare separate financial statements. But when consolidation takes place, the acquirer, which is the parent company, acquire the ordinary shares of the subsidiary. So when the acquisition takes place, when they are preparing they are preparing their financial statements, for example, financial position, which is known as a balance sheet, they will not be prepared separate accounts again. They will have to prepare what we call consolidated statement of financial position, because in this video we are going to cover balance sheet, that is a consolidated statement of financial position. The set of a financial statement are consolidated statement of financial position, that is balance sheet, consolidated statement of profit and loss and other comprehensive income, statement of cash flow, statement of changes in equity, and the notes. But in this video, we are going to cover that area of consolidated statement of financial position. And I will mention what we are going to break down here as when acquisition takes place on the days of incorporation, and what is the effect of that. The effect of that is that when it happened that way, the day of incorporation. What is the day of incorporation? That is the day that government allow the company to start production. The company to start production activities. That's the day he's given a certificate to carry on his business activities. So when consolidation happen on the incorporation date, that means there is no what? There is no pre-acquisition profit. The day that the company starts, that is the day of what? The day it was acquired. That means there is no pre-acquisition profit. Unlike a company that has started business from the day of incorporation, let's assume that maybe in the next 1 year the business was acquired. That means it has been made profit before the acquisition. That is, prior to acquisition, it has been making business activities and has been making profits. That is what we call pre-acquisition. Whatever profit that is made from the day of incorporation to the day of acquisition, that is what we call pre-acquisition profit. But in the case where acquisition takes place on the day of incorporation, that means there is no profit before the acquisition. So there is no pre-acquisition. What is pre-acquisition profit? Pre-acquisition profit is the profit that the subsidiary has made before the day of acquisition. So in the case where subsidiary was acquired on the day of incorporation, that means there is no pre-acquisition profit. Another concept where we are going to cover on this in this video is also when negative goodwill arise. When negative goodwill arise, what is the effect of this? According to IFRS, goodwill is what is an asset, and it has to be treated under the asset section in the balance sheet, which is also known as financial statement of financial position. So when negative goodwill arise, what is the effect of it, and what is the cost? According to IFRS, the cost may be because of what? Of the forced sale. That is maybe the acquiree, that is the subsidiary, that's the acquiree subsidiary company that the parent want to acquire. Maybe is on a forced sale, or maybe it's in a distress situation. Maybe they are not liquid. There is no cash to support the ongoing activity of the business. No, they are in a distress condition. So they have to agree to acquisition offered by parent company, because they can no longer continue for the foreseeable future. They have a going concern problem. So they have to be what? They have to be acquired by another company that have a financial capability to carry on the business. So if a company is in a distress circumstance, so it has to be what? They have to acquire it. If the acquisition want to take place, there is no choice for that subsidiary. You have to sell out at discount. Then you have to sell less than its worth, because the company has no option than for it to dispose its assets. So that may be one of the causes. Another cause is when there is a weak bargaining power. Maybe the management has weak bargaining power. Unlike the parent company, maybe the parent company has what? Has an edge over the subsidiary in the bargaining power. So the subsidiary has to what? Have to agree to whatever price that was being offered by the parent company, that is the acquirer. So another reason may be in the real life sense, in the real life example, maybe the parent company want to acquire the subsidiary for one reason or the other. Maybe the subsidiary is producing raw material that is needed by the parent company. So in this case, parent company might want to acquire the subsidiary company instead of the parent company to go outside the company to go and procure or to go and purchase raw material. Let us just have that option of acquiring a subsidiary company to be producing the raw material for it, the parent company, and as such, the parent company will have no reason for it to go outside and purchase the raw material. That is in-house production. So the two of them have to match together, and the subsidiary will be producing the raw material to be used by the parent company to make its goods and to produce its goods or services. So those are the possible reasons for negative goodwill. Then, what is now the treatment of a negative goodwill? Treatment of negative goodwill according to IFRS is that maybe, so another reason for the negative goodwill may be because of errors in calculation. Maybe the fair value, that was an error in the fair value calculation of the net assets of this subsidiary. Maybe there was an error. So what is the position of the IFRS in this case? The position of the IFRS is that reassessment should be what? Should be made. But when the reassessment is made and the same figure and still the same figure, that means that is a negative goodwill. Negative goodwill, maybe because of what? Because of a distress sale, maybe because of a bargaining power, maybe because of an error in calculation of the value of what? Of the identifiable net asset of the subsidiary. So those are possible risks. So and when that happens and it's a negative goodwill, the goodwill will be what? Will be recognized as an income, not as what? As the asset. And when it's recognized as an income, it will be added to the calculation of the consolidated retained earning. That is, it will be added to parent company retained earning for the consolidation purposes. So that is what we want to break down in this video. Another thing that we are going to break down is when the acquisition is 100% acquisition. When the parent company acquires 100% ordinary share of the subsidiary, when this happens, that means there is no non-controlling interest. All the shares of the subsidiary will be controlled. No non-controlling interest. All the shares, all the interest, all the control power is in the hand of what? Of the parent company. So in this case, there is no non-controlling interest when the consolidation takes place. So I go ahead now to write the questions and solve the question accordingly. Wireless PLC acquired 100% of the equity shares of others PLC on 1st June 2000X2 when ADEX PLC was incorporated. SPLC was incorporated. The following the statement of financial position of the two companies as at 31st December 2000 S2. X2. Then I have the wireless PSC, others PSC, let's say dollar sign, then non-controlling, non-current assets, you have property, plant, and the equipment. What's the value under others? Under others, the value is $800,000. Under wireless, the value is $700,000. This is the separate financial statement of the what? Of the two companies. For wireless PSC, this is the column. For others PSC, this is the column. Then investments in others. Investment in others PSC, 510. There is no for the others because wireless is what is acquiring. This is the amount you pay to acquire others PSC. Then you have a current assets. First, inventory, and that is for the wireless, that is 500. For others, that is 380,000. This is 510,000, and this is 500,000. Then you have a trade receivable. And for the parent, that's 250,000. For the subsidiary, 200,000. Then you have a bank. For parent, 200,000. For subsidiary, 180,000. Then you balance off the assets. For parent company, it is 2,260,000. And for subsidiary, 1,460,000. Then you go to equity, and the liabilities. And what do you have there? Equity share. Equity shares of 50 cents each. And for the parent, that is 600,000. For subsidiary, 350,000. Then share premium, that's for the parent, 310,000, for subsidiary, 240,000. Then you have a retained earning, for subsidiary you have 710,000, for subsidiary 420,000, sum it up. For parent you have 1,620,000, for subsidiary 1,010,000. Then you have a non-current liabilities. For parents, you have 380,000, subsidiary 270,000. Then you have current liabilities. You have for the parent 260,000, and for the 180,000, then the total of equity and the liabilities. For the total here, it must give us 2,260,000 and 1,460,000. If you do the calculation, so that is this is the balance sheet, which is a consolidated statement of parent. That's a statement of financial position. It is not consolidated yet. When it is consolidated, the balance sheet here, this separate of a oneness and others have to become one. So it's going to be name of what? The name that the two companies choose when they consolidate. So, but in this case, it's what it is, a oneness. So no more oneness and others when consolidation takes place. So this is a separate account of the two companies, and that's what we call consolidation. When consolidation takes place now, in the solution, it has to be only the wireless PLC. So we add together, for example, property and plant, we add together. Investments will no more show in the investments in others will no more show in the consolidation. It will be used in the calculation of the goodwill, that is for the purchase consideration. Then inventory will be added together. There is the inventory 500,000, 500 plus 380 be added together. For receivables, 250 be added together plus 200. Then bank be added together. If there is no transaction that affected them, they'll be added together. But if transaction affect them, adjustment will be made. That is, it will be shown under workings. So that is that about the asset. For the equity and liability, consolidation will take place. For the calculation of net capital and reserve of the subsidiary, all this will be used. The share capital will be used, share payment will be used, and return will be added together to form the net asset of the subsidiary. This will not be used for calculation of what? Of the capital reserve, that is net asset of the subsidiary. But for the WADES, for the wireless PSC, it will be used in what? In the when the consolidation, it will show up, share capital will show up in the balance, in the consolidated statement of balance sheet of the financial position. So also share payment will also show up in the consolidated statement of the financial position. But for retaining, some adjustment will be made to retain earning. Some adjustment will be made to retain earning. Workings has to be done outside before it is incorporated in what? In the consolidated statement of financial position. And what is that working? We are going to add the share of the parent company from the post-acquisition retained earning when acquisition takes place. Again, what will be added to this is we take this as retained earning of the parent company, then we are now going to add the share of post-acquisition retained earning from the subsidiary. When subsidiary was acquired, what is the retained earning what is the profit they have made after the acquisition? So share of post-acquisition retained earning will be what? Will be added to this. So also, if there is a negative goodwill, as we have here, the negative goodwill, so like I said in the beginning of the video, negative goodwill will be added, will be added to retained earning of the parent company for consolidation purpose. Negative goodwill will not be treated as what? As an asset, because when it's a negative goodwill, it's no more an asset. It's an what? It's an income which should be added to parent company retained earning. So that's how we treat that. For the current liability, it will be consolidated together. We add that of the parent company 380 plus subsidiary, which is 270. For also current liability, we add together and consolidate in what? In the consolidated statement of financial position, right? So that is that about consolidation. But if there are transactions that affected all this addition of inventory, of trade receivable of bank, of non-current liability and current liability, adjustment will be made in the workings. But in this case, for simplicity's sake, this is just what? A simple group account. So let's go with the workings before we go for the preparation of the financial position. Workings are working one. That is group structure. What's group structure? Group structure is the what? Is the percentage of acquisition. And according to the question, we say Wades PLC acquired 100% of the equity shares of Ades PLC on 1st of January when Ades PLC was incorporated. And that is what we have our wireless PLC. We put arrow to show the acquisition of what? Of Ades. Acquire Ades PLC. On what date? What's the percentage? 100%. What date? That is the 1st of June 2000x2. That's working 100%. In this case, what does this mean? That means there is no non-controlling interest. Let me put it here. No non-controlling interest. Because all the 100% of what has been acquired. When 80% was acquired, that means 20% is going to be what? Non-controlling interest. If 70% is acquired, 30% is going to be non-controlling interest. If 60% is acquired, 40% is going to be non-controlling interest. But in this case, all the other shares of what? Of the subsidiary was acquired. So working two, calculation of a capital and let me put it there. Calculation of capital and the reserve in brackets net assets of the subsidiary, which is what? Of Alice PLC on the date of acquisition. What is the date of acquisition? That is 1st of June 2000x2. Then then we have our date of acquisition, date of consolidation, and post acquisition retained. This is retained earning. Then you put the dollar sign, DOA means date of acquisition, DOC date of consolidation. Then you have the start, like I said, in the balance sheet you have their net asset, which is 1 share capital, that is under the column of others. We have 350 for the share capital, that is equity, 350,000. Then on this is the date of acquisition, we go there. So under the date of consolidation, you also have 350,000, and the difference is supposed to come here. Assume the difference between this and this, but there's no difference. Why is that no difference? Because there is no issue of share after the acquisition. If there is an issue of share after the acquisition, issue of share will have the value will have will have changed, and that will be in the notes. But in this case, there is no much note, so there is no even note. There is no transaction that affected this. So it remains the same. Then we have a share premium. Under the balance sheet, you have for the subsidiary, you have 200,000. Then there is no issue of share. The figure remains the same. No difference. Difference will come to this place. We have retained earning. If you're a new subscriber and you have been deriving value all along, do subscribe to our channel. And if you are an existing subscriber, don't forget to continue sharing our video for more subscription by the viewers. So our video will have a wider coverage, and that shows that you are supporting us to continue uploading more video like this for more subjects like financial accounting, financial reporting, corporate reporting, financial accounting, cost accounting, management accounting, and so on and so forth. All many accounting related courses. All the accounting related courses will be uploaded in our video. Do support us by subscribing to our channel, and as you do so, and God bless you. Okay, for retained earning, we have a 100 80,000. No difference. Okay. Look at this way. The question says, Wireless PLC acquire 180. Wireless PLC acquire 100% of the equity shares of Wireless PLC on 1st of June when Wireless PLC was incorporated. When it was incorporated, right? This is date of acquisition. There is no pre-acquisition profit because that is the day this is date of acquisition. The day that the parent company acquired the subsidiary. The day that Wireless PLC acquired Wireless PLC. There was no profit. They have not made any profit. That's the date of incorporation. That means there is no what? On the date of acquisition, no pre-acquisition profits, like I've said in the beginning of the video. So the profit we have in the balance sheet is what? Is for the date of consolidation. It was acquired on 1st of June 2000X2 and it was consolidated on 31st December 2000X2, right? That is about 7 months interval. So the profit they make what is the profit is after the acquisition. That's what we call what? Post-acquisition retained earnings. So it has to come under that profit has to come under date of consolidation. So this is added together, and this is what we call what? Post-action retained earnings. It will come under this place, 180. So we add it together. What is the net asset at date of acquisition? And that is what? When you add it together, it gives 540,000. 540. While base gives 770. And if we deduct this from this, it gives the difference, which is 180. This is what retained, post-acquisition retained earnings. So let's go to, we're supposed to have number 3, which is non-controlling interest, but in this case there is no non-controlling interest. It remains only, we calculate the goodwill, so I have to rub this off. And this is a working 1, this is working 2. I'm going to prepare the working 3 and working 4. Working 3 is going to be goodwill, and working 4 is going to be consolidated retained earnings. Consolidated retained earnings. So I rub these two workings off. I rub it off to allow me to present the remaining two workings, which will be used in the preparation of the consolidated statement of financial position, which is the balance sheet. Okay, working 4, calculation of goodwill. And first of the item there is what? You have the dollar sign, you have a cost of investment, which is in the cost of investment that we have in the balance sheet under Wireless, which is $510,000. You add, according to the format, add non-controlling interest, 100% acquired. Let me put it here. In bracket, 100% acquired. No NCI, that is no non-controlling interest. That means nil. So you add it, it gives you 510. Then less it, And this is what? Purchase. This is purchase consideration. That's purchase consideration less net assets. Net assets of the subsidiary at the date of acquisition. And what is that? We have it in the workings, and this is what? There is a working 2. We have this in the working 2. And what is that figure? That's the $540,000. So you less it, and that gives us that's 590, not 540. There was an error in that calculation. When you add 350, plus the 240, it gives 590. There was an error there. I wrote 540. Please take notes. So in this case, this is going to give me 80,000, which is negative goodwill. Why is it negative goodwill? This is negative goodwill when the amount to acquire is less than the worth of what we want to buy. What is less than the net asset of the subsidiary. That's what the parent company is buying from subsidiary. This is net asset. So this is the value of it, and this is the amount that the parent company is paying, 510. It's paying 510 to acquire 590 worth of the net asset. That means the amount is being paid is what is a lesser, and that is negative goodwill. And that was what I said in the beginning of the video, that what is possible causes for the negative goodwill maybe distress sale. That is the subsidiary is in a condition, it's in a constrained condition. They are not liquid. They are having cash problem, or they are being forced to sell. So they have to sell on discount. So less than its worth. Something worth 590 is being bought by 510. That's at discount, and that's negative goodwill. And I said that this negative goodwill will not be treated as what? As an asset. To be treated as what? To be treated as income, to be added to parent company retained earning. And that's what you are going to see now when we are calculating consolidated retained earning. This is the negative goodwill. Negative goodwill. Then we go to working 3, and this working 4. Calculation of consolidated retained earnings. And first on the item, you have the dollar sign. And first on the item is a parent company retained earning. Retained earnings only. And what is that amount? Like I said, in the balance sheet, we have $710 million. Like I said, that is what? $710,000. That's parent company only. Then you add share share of post-acquisition retained earning. Retained earning share of post-acquisition retained earning from subsidiary, and that's ADES PSC, and that is a working what? Let's look at it. That is a working one. That's from working one. So what is that amount? The amount is a 420. That's what I'm trying to say. 420,000. Add it, and that gives us what? That gives us 1,130,000. So you add negative goodwill, add negative goodwill. And what is that amount of negative goodwill? According to the calculation there, that is 80,000. So if you add it, $8,000 plus 1,130,000, that gives me $1,210,000. And this negative goodwill is coming from a working what? Coming from working 3, which you have here, working 3. So this is negative goodwill, and this is a goodwill, which is negative goodwill, and this is a calculation of what? Consolidated retained earning, and this is a calculation of goodwill. So I rub it off to present the balance sheet, which is the consolidated statement of financial position, or statement of consolidated financial position, and that is the balance sheet, and that is what we are dealing with in this video. Once again, if you are a new subscriber, don't forget, please subscribe to our channel. If you are new to our channel, subscribe to it, and if you are an existing subscriber, please do continue to share our video, and so that I can have a wider coverage of our video. What is it? We are presenting, like I said, whenever I want to present balance sheets, you have to first of all write the owner of the company, then write what you are preparing. So what we are preparing now is what is a statement of consolidated financial position, or consolidated statement of financial position. What date? As at so date. The parent company is now the name. That is now consolidation now. This is consolidation. So the parent company is now the name. Wallace PLC. What are you preparing? Consolidated statement of financial position. Let me do it so that it will contain straight line, only one because of space. Consolidated statement of financial position as at 31st December. 31st, let me short it, 31st December 2000 x2. This is the heading. Then I go, first on the item there is what? And that is a non-current asset. You have the dollar sign. You have the dollar sign. Then you have a non-current asset. Non-current asset. You have it has been consolidated. We add the two together. 1,500,000, like I said in the beginning of the video, he had both the parent company and the subsidiary together when there is no what? Transaction that affected the non-controlling, the non-current asset. No transaction affect them in the note. There is no note here. There is no note here. Add the two together. Both columns add it together. Then you have and this is for example, this property, plant, and equipment. Because of space, let me just put it there. This is a non-current asset. Property, plant, and equipment. Property, plant, and equipment. Then goodwill. Is that going to be goodwill? No. Simply because the goodwill is what? Is a negative goodwill. And that is a working 3. So it will not be treated. It's going to be treated under what? Treated with it will be added to what? This is NIM. To be added to what? Added to consolidated retained earning. So it will not take off, it will not be added. Ordinarily, goodwill is what is an asset. But because it's negative goodwill, this is where it's supposed to work to appear. But it will not appear because it's what is not an asset anymore. It's what is an income. It will go to what? To equity and liabilities. To go to under equity. So you have a current asset. First on the line, inventory. And what is that? 880. The two has been consolidated. We've added, we checked the video. If you watch back, this is the figure. You add the parent to what? To the subsidiary, the inventory figures. Then you have a trade receivable. Receivables. No transaction affects inventory. No transaction affects inventory. And no transaction affects receivable. The figure remains the same. You add the two together, and that gives you 450,000. Then you have bank. No transaction affects it in the notes. There is even no note. You add it together. Both parent company and the subsidiary, and that gives you 380,000. So you add all of them together, and that gives you the total asset. And the total here is what? Is $3,210,000. This total asset. This total what? Assets. Then you go to equity and the liabilities. Under equity, you have a equity colon, and that's a equity share. That's a equity share. That's a parent company. Parent company only, and that is according to the balance sheet, you have a $600,000. You have a share premium. Parent company only also. parent company only, and that is a 310. That for this two, that of the subsidiary has been used to calculate the capital and reserve of the subsidiary. And what is capital and reserve? That is the net asset of the subsidiary that has been used in the working. That's the working two. So it will not be added together here. We only pay the equity share of the parent company. That's the 600,000 for parent company only. Share payment for parent company only. Then you have a retained earning. That's retained earning. That's consolidated retained earning. Retained earning. And that is a working what? That's working 4 to be used here. And what is that figure? What is the figure? And that is a 1,210,000. 1,210,000. Right? We sum it up. This equity of the parent company, and that is a 2,120,000 $2,120,000, and this is what? This is the equity of the parent company. Then you have NCI. That is the non-controlling interest. Okay, let me write this in full. Non-controlling interest. NCI. And that is nil. Simply because 100% acquisition, let me short it briefly. Because of 100% acquisition, there is no non-controlling interest. Assuming 80% is acquired, A is going to be 20% of what? Of the net asset. There is no non-controlling interest. Everything what is acquired. So we have a nil here. So we sum it up, we still have 2,120,000. Then we now have what do you have there? You add the so and this now become what? The equity of the entire group, and that is what we have here. We add the equity of the parent to the what? To the NCI, give us equity of the entire group. So we now have non-controlling interest, non-current liability, non-current liabilities, and this is it. That's a 050. If we add that, both of the parent company and subsidiaries together, because no transaction affected it, so you have 650 there. Then current liabilities, current liabilities. And what is that figure? That's a 440,000. So you sum it up, and that gives you the same figure, 3,210,000. So no transaction affected current liability also will remain the same. Add that of the parent company and subsidiaries together, and that gives you $440,000. And that's the end of the figure. Once again, this breakdown of when acquisition takes place, when the 100% was acquired, 2, it gives rise to what? 100% was acquired, and that is while there is no non-current, there is no non-controlling interest, then goodwill give rise to negative goodwill. Goodwill is supposed to be treated here, but because of negative goodwill, it was added to what? To parent company retained earnings in the workings, and also there is no pre-acquisition retained earning, and that's how you have it in the workings. As soon as there is a pre-acquisition retained earning, this figure will have been more than this. So that is that about the consolidated statement of financial position under group account. Thank you for subscribing to our channel, and God continue to bless you. See you in the next video.